Sure. Okay. I'm going to have you start.
Okay, we are live whenever you're ready to go.
Okay, just give me one sec.
How about shorting
Let's make some money,
SLV?
folks.
How about shorting SLV bakes?
Okay. My whole thing with silver is, you spend 40 years under $50, the commodity, and bears want to say, well, it's been 6 months above that level, and so that's plenty. And I don't. That's asymmetric to me. And so I think that this looks like a reasonable consolidation. I've sold some because I doubled my money in a year, and we've chronicled that here. But this doesn't. This looks like an orderly consolidation to me. I could even, if I want to be fancy, I could draw triangles. So my whole thing is just the time. Uh, when market forces keep you under a price level for 40 years, and then you're emancipated, I just think it's illogical to think that it reverses in 6 months.
Yeah,
That's
no,
me.
I'm with you on the secular. Absolutely with you on the secular. I shorted it last night just for a trade,
Okay.
and it's already down
Okay.
6% on. So
Yeah, it doesn't seem like it wants to spend much time in the 60s. That's the way I sense it.
well, some of these
John,
things that
how we
do
making money?
go, some of these things that do go Eiffel Tower, the way silver has, they
Yeah.
they they often, very often, will go back and retrace their breakout levels, which would put you in the 40s. Anyway, we'll see. I mean, I'm with you on the secular. I like the precious metals and hard assets on a secular basis, but I think there are liquidity issues that are going to force profit taking in some of these things, because those are the things that you have profits in. And
Is your Canadian friend guiding you in this trade?
Nope, this is me.
Okay. All right, Charlie. What are we talking about?
We get started. What do you think?
Charlie, let's
Yeah,
go.
Okay.
Everyone's busy trading, so no one's watching.
There's a few things going on. So anyway, let's get started. Welcome to Wall Street Beats. My name's Brenna Barchet. I'm here with my colleagues Charlie Peabody and Kevin Baker, and today is April 2nd. Hopefully no one got tricked and spoofed too much yesterday.
It was April Fool's on our president.
And maybe on people's shorts yesterday as well.
Yeah.
Anyway, Charlie, maybe we can start with you. You have some stuff related to the BDCs, I think.
Yeah, I do. So on Sunday night, I wrote a report entitled "The Liquidity Vice Grip is Tightening on Private Credit." And anyone who has followed my writings know that I believe the analog to today is 1907. And in 1907, it was the non-bank, in that case, the trust companies, that were the epicenter of the credit problems, and a liquidity crisis developed around these trust companies, the most notorious of which was Knickerbocker Trust Company. And I said, today, that analog is going to be these private credit companies, and BDCs being a subsegment of it. And I said, on my Sunday night piece, I said, I think we're on the cusp of a liquidity event in these BDCs. And I gave 6 or 7 examples of how it's this vice grip is starting to tighten. So this morning, and actually yesterday as well, I'm sure the news leaked, but you saw the BDCs trading off quite aggressively, and private credit companies like Apollo, Mary, Blackstone. The dogs have come for the BDCs. Anyway, so these stocks are trading up aggressively today, and the latest is that Blue Owl acknowledged this morning that they've gotten significant redemption requests in two of their funds. Their largest, which is actually one of the largest in the industry, with 36 billion in assets under management, is called the Blue Owl Credit Income Fund, and they've got redemption requests equal to 22% of exposure. And then a smaller Blue Owl Technology Income Fund has gotten 41% requests. So that's much larger than anything we've seen previously. What we saw, at least through February in the first quarter, Ares had a request for 12%, Apollo 11%, Cliffwater 14%, Morgan Stanley's private income fund 11%, and BlackRock, HPS was 9%. So basically, low double-digit requests of redemptions, through February, and now we're getting 21 or 22 and 41, 42% type of requests. So the liquidity crunch is accelerating. And that was one of the things that I had written in the Sunday night report. By the way, I did post this morning an excerpt from that report. So if you want to read about the redemptions and some of the issues there, it's on Wall Street Beats now. So let me run through some of the things that I was observing and why I think this thing is going to accelerate.
Charlie, real quick,
Yeah.
are the gates 5% a quarter or 5% a year?
5% a quarter is
Okay,
the
thanks.
cap. And so the redemption requests obviously are coming in significantly above that. For the most part, the funds are, sticking to that 5% cap. There were two funds. One was the Blackstone Private Credit Fund that honored the entire redemptions of 8%, and the other was the Oaktree Strategic Credit Fund that honored the entire 8.5%. All the other guys have been capping at 5%, which is scaring, obviously, investors. So let's talk about some of the things I'm seeing. In terms of, these are all come under the heading of the liquidity is being constrained for this industry, and that's going to prove to be problematic, not just for the industry, but I think the market as a whole. The first is, recently you've seen the commercial banks tighten up on their liquidity rails that the private credit industry rides. And so, for example, JP Morgan recently went into all of their loan portfolios, the loans that they're making to these private credit companies, and looked at the software loans in their portfolio and revalued those downwards. So if they had lent 100 million, to Blue Owl based on their software loans, and then they revalued those software loans downwards, that means Blue Owl has less collateral value against which to borrow against, and so therefore less liquidity. So that's one area where you're seeing the banks tighten up on the liquidity rails that these BDCs are riding. The second thing that you're starting to see is the banks are setting up their own private credit direct lending funds. JP Morgan set up a $50 billion fund, Bank of America set up a $25 billion fund, et cetera. So what they're going to do now is they're going to compete at the point of loan origination for credits rather than letting these private credit funds compete unfettered. And this is possible now because the regulators in the banking industry have loosened the capital requirements for leveraged loans. So banks can now compete more aggressively. So in a sense, you're taking away the lifeblood of these private credit companies by allowing the banks to now take share back. So that's another sort of form of liquidity constraint. The third thing, and I'll do these rather quickly. Third thing is the gating that has gone on, capping things at 5%, is reducing the inflows from retail, from family offices, from pension funds, university endowments, et cetera. So in the first couple of months of this year, inflows dropped by a third to 1.1 billion, down from 1.8 billion last year. So again, another sign that liquidity is being constrained. The next thing is that you're seeing high profile defaults now in this leverage loan industry that BDCs hold. So default rates are running around 5-6% today, probably going to rise to 7-8% just in a normal environment. That would be a normal default rate, but could go to double digits in a recessionary environment, which I think there's a chance we'll be at by the end of this year. So as defaults occur, obviously your AUMs go down, and that restrains liquidity and your fee income going forward. The next area is one of the things you have to remember is how private credit was sold to investors. The key theme was you could get above market returns, but in return you had to give up some liquidity. Now, if you look at the returns of these, BDCs, you're getting below market returns, and you're not being able to get your money out because you're being gated. So that's going to stop inflows as well, which restrains liquidity. And then finally, the last thing I want to point out, because I think it will be a telltale sign, somewhere here in April. Anybody who knows Boaz Weinstein of Saba Capital knows he's a very shrewd distressed debt investor. He has out there a tender offer to buy stakes in Blue Owl and Starwood, by the way, and Starwood at 25 to 35% discounts to NAV. My feeling is that that's going to be binary. He's either going to get overfilled or he's not going to get anything. Given this morning's news on Blue Owl's request, my guess is he's going to get overfilled. And that means that there's going to be another round. If he's overfilled, in other words, he'd be oversubscribed for his bid, that means there's going to be another round of, I don't know the words panic, but another round of, aggressive redemption requests across the industry. So I think this industry isn't. Go ahead.
Can I interject a couple of questions? I mean, you've painted a very compelling case of all the bad stuff going on here. I'm curious, in terms of the trade, is it too late to be short something like Owl now that you have Boaz and coming in as a potential distressed purchaser? And I think maybe even the more important question for our audience is, where's the contagion going to be from this? And in terms of the big banks, and is this kind of the tail wagging the dog on larger financial institutions, or is this reflective of larger problems across private equity portfolios everywhere, to the extent that it could cause credit issues for larger institutions?
Yeah. It's a good question, Bernard, and there are a number of ways to follow this trail to different areas. But so let's start with the BDCs. Your first question is this sort of the final leg down? And I think it is. There's another leg down here, and I think it sort of will create a washout event in these BDCs. But I don't think you want to be premature in trying to catch that falling knife. But I agree. I think you've got one more leg down here before you get some kind of bounce, later this summer. And we'll have to play that by ear. The ripple effect, no doubt, is going to be in credit on the leverage loan side and for high yield. I think, you're going to continue to see declines in credit quality. There's a deal that JP Morgan was syndicating called on Sealed Air, the Clayton Dubilier buyout of Sealed Air, SEE, $7.2 billion deal, debt deal. They started pricing this thing at 98, 99 cents, 8% yield. It got done this morning finally at 8.5% yield, 95 cents discount. So that's the kind of thing that's going on there. So if I'm right that we're going to continue to see big discounts required to get loan syndications done, we're probably going to see hung loans in the title of every media outlet there is. So front page of the Wall Street Journal will read somewhere this spring, hung loans. And that means credit has completely dried up. The buy side isn't going to buy anything, no matter what the price is.
You know, that has interesting implications from sectors I think far from finance, because we've seen washouts in things like SaaS software, and I think, you know, for people like me, you know, who's sort of playing in distress in these more operational industries, um, you know, for a long time the thought was that, you know, private equity is kind of the floor on some of these. But if it's going to be hard for them to finance new deals, or if they're going to be sort of plugging holes in their existing portfolios, you know, companies that need refis and you know, additional capital, and capital's tight, that mechanism of private equity being the floor on smaller cap public market companies may not be as functional as it has been in prior pullbacks.
You're spot on, Berna, and so right. Yeah, and that's an important observation, because what you're going to see, well, what you have seen, I should say, is it's been very hard for these private credit companies to monetize, their investments. And the big deals that you're seeing are in M&A, are the in private equity, I mean private in IPOs, have been mega deals. It's the Anthropics and
I mean,
the
SpaceX is going to be the biggest IPO of all time, right? And that's going to
yeah.
sop up a lot of capital.
Yeah, but you're not getting those smaller deals, and that's, I've highlighted this in the past. Bakes knows I've been very negative on the Goldman Sachs, the Morgan Stanleys, the J.P. Morgans that have been short them, and the reason is that all the data that I'm seeing indicates peak market activity. Um, and so that can happen, that can last 1 or 2 quarters, but it's not going to last 1 or 2 years. And so the question becomes, what do you want to pay for peak capital markets revenues? And you're already trading at 2.5, 3 times tangible book on these stocks, which is very expensive. So I think capital markets activity is going to be volatile this year. First quarter is going to be very strong. I think second quarter is going to be very weak. So when my banks report in 2 weeks' time, they're going to report great numbers, but I think the guidance is going to be soft.
So if somebody didn't have a position in any of these companies today, or would you say any of them are kind of fresh shorts, like,
I think you
the
can
Goldman,
short Goldman.
Morgan
Yeah,
Stanleys?
I think you can short Goldman. You can short Morgan Stanley. You can short J.P. Morgan, Wells Fargo. One of the things that we've seen is the portfolios for purchasing and carrying securities. This is government data that comes out every Friday, is skyrocketed. And so the prime brokerage business of these big guys has been just going gangbusters for the last 5 quarters. And what they're doing is they're funding counterparties who are creating this asset bubble in credit. And if that credit cycle comes to an end, you're going to see a lot of that financing revenue turn south. And so people who think that financing revenue is an annuity source of revenues are going to be disappointed. It's going to prove to be just as cyclical as, the IPO business or the M&A business. So yeah, I've been very negative on the capital markets. They've actually underperformed the regional banks, where I've been more constructive. The one money center bank that I remain constructive and has some unique aspects has been Citigroup, and Bakes has called that one as well. So kudos to him.
Got
Now,
it.
can I add one last anecdotal story? Howard Marks, who
I was
ran,
just going to ask. You read my mind.
yeah, he ran Oak Tree Capital Management. Back in 2019, he sold a stake to Brookfield Asset Management, but at that time retained, I think it was 26% of Oak Tree, and said he would always retain, a minority stake, no matter what. Well, in October of last year, of 25, he sold that remaining 26% to Brookfield, and that deal closed here in the first quarter. Now, Howard Marks, in my mind, is one of the best credit investors. And
Agreed.
his decision to completely get out is very similar to when Sam Zell sold his commercial real estate portfolio to I think it was to Blackstone. Yeah, it was to Blackstone. And Sam Zell was known as one of the best in selling at the top. And I think Howard Marks is going to go down as having sold Oaktree at the top.
Huh.
So
Interesting.
the credit cycle is here, and it's going to get worse. Bottom line.
So, Bakes, anything? Do you have anything to add on any of these bank charts that we've referred to?
Yeah, I mean, Charlie's been right on this. I think he was. I think he admitted he was a little bit early, but now he's right, and being early and right is great. I'm going to use this as I think his Citigroup is unbelievable, and I talked about it on the last show. I forget who was on. Maybe Charlie was or wasn't, but J.P. Morgan is very weak in my opinion, and it can't muster enough buying enthusiasm because frankly everybody owns it. People genuflect the Jamie Dimon, and but I think that's coming to an end at 3x book. It has this feeble rally to 300, and but I juxtapose that with Citigroup. I mean, this is a much better looking chart. I hope people can see that it's above the 200 day. The volume's behaving itself. This is a nice channel that it's in from 100 to 126 or so. I still think 140 is the number that it eventually comes to after going back to the 2008 breakdown in price. But I'm with him. I think, and I'll segue into my ETS, if you will. This is SEF, ProShares Short Financials. It shorts the financials, and it shorts in particular Berkshire, J.P. Morgan, and Visa at the top. It's about 30% of that index, and all of those. And talking about Visa looking bad, used to be heresy. Well, now it looks bad. And it's just time. And I think Charlie's spot on. I have not pulled the trigger on SEF. I encourage people to stay here, and I'll tell you exactly when I add to this. I have a very strong buy discipline, so I wait to see the whites of their eyes. But they're coming on the bluff, and I'm loading the musket. So.
One thing I'll add, because it came out last night as well. Besant is now going to bring together all the insurance regulators to review the purchase of private credit by these insurance companies. And if you recall correctly, some of these insurance companies are captives of the bigger private equity. For example, Apollo owns Athene. And Besant gave a very important speech about a month ago at the Economic Club of Dallas, in which he said, I will not allow the problems in the non-bank system to spill over to the regulated financial system. And he was specifically referring to captive insurance companies. And so I think there is going to be an investigation into these private credit companies as to whether they transacted with their captive insurance companies on an arm's length basis. If they did not, if they used rating agencies like Egan-Jones to falsely rate credits and put them into these insurance companies, I think the Treasury will make these parent companies like Apollo take back those credits in order to protect the regulated insurance companies. And that has very significant implications.
Well, yeah, Charlie, that's if they're U.S. based, but a lot of these are in the Caymans and elsewhere, and I don't think his reach extends that far. Correct?
His reach probably does not, but those regulators, it's actually specifically mentioned in the Treasury commentary. They're bringing together the regulators internationally, so it includes the Cayman Islands.
Okay.
Now,
that sounds like herding cats.
Yeah, whether those regulators will follow Besant's desires is to be determined. But it is an international conglomerate of insurance regulators that are going to be meeting. They're going to have a series of meetings over the next couple of months to review how insurance companies are being used by private credit.
I got a couple more things I want to talk about, if that's okay. So SEF, I have not pulled the trigger. I'll let you know when I do. I'm looking very closely at SARK, SARK, which shorts Kathy Woods, ARKK, her ARK fund. This is a, you know, this is forming a beautiful base. The volume is picking up on the upside, and Tesla is her number one name. They just reported missing car shipments. I know they don't think they're a car company anymore, but it doesn't matter. This stock is going down, in my opinion, and it's going to take ARK and thus SARK, which goes up daily one times the inverse of Kathy Wood's fund. uh, I think is going to be uh, very promising. Again, I have not pulled the trigger. I'm waiting for a couple of indicators to trip, if you will. But and I've got a little bit of soft spot in my heart because this is why I made money in 2022 with an S&P down 20%. This went up along with shorting SPACs was a really good thing to do. So stay tuned here. Look at the chat, and I'll let you know exactly when I decide to short ARK's Kathy Wood's ARK. And I got one more. Okay. And I've talked about this on the show before, but I just want to give people a sort of a drum roll because I think when this finally turns, it's going to be a very promising an additional short. This is the ProShares China 25 ETF YXI, and this is again forming a base. Tencent and Baba are the top two names, and I'll let you know when those start really starting to go down, and they've already started. But when it accelerates to the downside, and the fact that we now control 20% of their oil, I think is a reason enough to make this questionable. So stay tuned here. Um, uh, I'm very. This is going to be very promising. So I could be 30% short. I'm right now 39% in cash. I'm up 12% for the year, beating the index by 16, 17%. And my discipline flat out is working. So I'm going to stick to it. And I hope I've been added some value by having my self discipline become more prominent here. I've got one other short that I'm looking at, and I'm going to over the weekend. It's the end of the month. I'm going to go through 5,400 plus charts, and come up with my 10 best. I own 9 right now. There's another one I'm looking at, and then this just broke. This is a stock that I have mentioned in the past, which I thought was dead. This is Kodak, and it is breaking out today. I haven't even had time to see what the news is, but Kodak, which I've mentioned, I don't know, 3 or 4 times over the last 6 months, it's coming to fruition. Um, that's a bullish chart. And Kodak, I don't know what the heck is happening today. I'll look at it and I'll report back. But in a red tape, that's a pretty good performance in my opinion. And then before we go, I want to brag on Berna. Because I was going to mention this before, and then I realized that Berna was moderating the 5. I mean, they've thrown all 5 below FIVE. They've thrown a tremendous amount at this stock, and look how it's held in. It's actually gone up in earnings, which a lot of stocks have not done, and it's just been an absolute champ. So a tip of the hat to you. I'd love to have you go through, why you bought it initially and the ensuing buys. But what a homer for all of our members.
Well, thank you. It's funny because you were actually before you mentioned that you were looking at this chart. I was actually, I was just going to mention it briefly today because I had sort of a timely but very qualitative thought. So, this is a stock that I attended. I think it was maybe the first analyst day that they'd done in a long time in 2022. And I was so impressed by the company, and I bought some. I'd been following it since the IPO, but it had always been a little too rich for my blood. I definitely leaned to more, the value in GARP names. And I was so impressed by both their merchandising and their operations and sourcing that I decided, and it was always a great story because this is one of the only growth retailers left in America that's growing, at the time, square footage, number of stores by like 15% a year. And they were comping positive. So you had like a 20% grower between comps and new stores and operating leverage, 20% plus, to find that kind of compounder in retail in America, very rare. So everybody was crowding into this stock because it's such a rare beast in the retail area, a true growth company. It was never really cheap enough for me, but I bought it in 2022, probably in 140s, 150s, on its way to north of 200. And, something I've been working on in the last 5 years is trying to hold my winners, right? Because I am by nature contrarian. I'm always willing to step into the breach. And there have been a lot of like 10 baggers that I turned into 3 baggers, right? By, buying them when they were totally out of favor and then selling them, when they recovered to a reasonable valuation. But then they went on to like an inflated valuation and also, grew earnings, beyond what anyone had imagined. So I'm trying to get better on not selling too early. In this case, it hurt me because the company made some missteps that were totally self-inflicted. Operational stuff, like they cut labor too much in the stores. They sort of rested on their laurels too much on marketing and didn't bring enough on merchandising. I apologize, and not bringing enough new merchants, new merchandise into the store. So they got a little lazy. They got a little greedy on the cost side with cutting labor, but kind of totally fixable things like the merchandising issues. The merchants were mostly still there. So it's not like the people who had created the magic had gone away. But when they went from just knocking it out of the park to a rare period of them for negative comps, the company lost 2/3 of their value. And so that goes back to kind of late 2024, early 2025, where it got into the 70s. And that's where I doubled my position, kind of mid 70s. And that's when I think I had mentioned it, on the way down. I kind of caught the falling knife and said it's maybe time to inch in. But then when it got to the 70s, that's when I doubled my position. And then it went to the 60s. And then I, brought it up again by another 50%, but essentially tripling that initial position down near the lows, which I think were around $56. So anyway, was pounding the table in the 60s and 70s. I think I sold a little bit when it doubled, like maybe like 25% or 30% when it doubled, but I've held the rest. And, it's
Good for
getting to the
you.
point where it's fairly valued now. And I was thinking, okay, should I trim this? Because it is one of my largest positions. But then qualitatively, something's happened in the last week or two that makes me think that there's going to be another leg here. And that is, and this might be familiar to anyone who has teens, tweens, or even kids in their 20s around. There is a trend building in stress balls, basically. I'm calling this the second coming of the fidget spinners. And there's a company called Needo, which unfortunately is privately owned. Otherwise, we'd have a stock for you, Needoh. And if you go on like Instagram or TikTok, you'll see a million videos of people searching toy stores, Target, Walmart, Amazon, CVS, Walgreens, in search of these squishy things, which were priced $15, right? And you cannot find these. Like if you they're putting limits on them on Amazon, they're selling at, a store that has a $12 MSRP is selling at $60 on Amazon. We're talking 5 times markups. It's basically, this year's Labubu is these Neatos. But no one can get them, and it's spread into fidget toys of all types. So people want these squeezy balls and shapes and whatever, and it's not just kids; it's going up into young adults. And Five Below, this is the kind of trend where they lean hard, and so I think a lot of people have been wondering, how are they going to comp, such a strong year last year. But it's been proven in the past. Fidget spinners, was a good example of that for them, where these kind of trends drive incredible traffic into the store because people are looking for the sort of off-brand Nitos, the other kinds of squish stress toys. And so they're going to be checking their Five Below regularly to see what they have. And I've already started getting on my Facebook and my Instagram ads from Five Below that they've got, dumplings and bears and cows and whatever in the squid. They're chasing this. And so, if, as an example, I went to a Dollar Tree this weekend. I never go to a Dollar Tree. I went to a Dollar Tree because we were searching for squish toys. So this is, every mom in America who's trying to put together an Easter basket is familiar with this phenomenon right now. And so I think this is going to be a traffic driver for at least the next 6 months for Five Below. And the fact that it's hard to stay in stock, people are hunting them. It's driving trips. So I think there's another leg here. This stock is, kind of trading 17, 18 times 25 EBITDA, 15 times next year's. But I think we have a 15 to 20% grower. So, it's not crazy. And, it used to trade in the 20s on this multiple. So, it's more mature than it was when it was traded at that multiple before, but it's by no means sure. So, as I said, I sold that, 20, 30% of it, 100 points ago. I'm not selling anymore right now.
Let me draw this for you. This is the all time high back in August of 21, 237.86. And look how the market is paying its respects to that level right now. So you had earnings that were great. The fact that the relative strength line, look at this thing, is incredible given the we've thrown tariffs and $110 oil at this name, and this is how it responds, which I think is incredible. So you should probably spend some time under this 237 level for a while. But if you're right, and the stress balls trend goes through Christmas, there's no reason why this can't tack on more upside from here. And so for our members, if you're keeping score at home, that's roughly a triple from the 70s in the span of 2 years from Berna. So good for you.
And just on $100 oil, I would just say that is a double-edged sword. Clearly a lot of things are made from plastics here. It is a inflationary factor for them. It's an inflationary factor on the utilities, on freight, all those things. Although, this is the low-cost provider in the market for things like toys that you can bring to a birthday party, for Easter and Christmas gifts, for seasonal decorations for your home, for events, for cosmetics for tweens and teens, for balls and other sporting equipment, and tech gadgets like chargers and phone cases, and things that people generally, small wants and sometimes needs, right? And so their costs will go up, but basically they're cheaper than Target and Walmart. They're as cheap as you can get. So if you're so historically, the dollar stores, including Five Below, have been beneficiaries of a difficult macroeconomic environment because people trade down into them. Because as long, it's one thing if you can't pay your rent or your car payment, but as long as those two things are covered, if you're cutting back, you're not going to show up at a children's birthday party empty-handed. You're not going to have nothing under the tree for Christmas. There are certain, your kids come first, and you may not let them shop in, Toys R Us or whatever the equivalent is now these days, now that there isn't Toys R Us. But, you may be trading down from Mattel and Hasbro, or L'Oreal at CVS, and into these cheaper things. But I think it's a trade down beneficiary. I think it's also a trade down of beneficiary of people, staycationing instead of going on vacation. If you're sort of staying close to home for your spring break, your kids can get a lot of amusement and runway out of $20 at the store. So whereas I think that's why it held tight, when most of retail came in 20 or 30% recently with the spike in oil, this company did better because I think people know that, when you stop going to Macy's and you're going to Walmart, you're also going to Five Below. So, it's a double-edged sword, the oil situation.
Great work.
So,
I have, I
anyway,
have a, I have a question I think is going to be very important to answer for next week's trading. What do you guys first give the odds of boots on the ground this weekend? And number two, what do you think the market reaction would be on Monday if there is boots on the ground this weekend?
I think the market would be down for sure, right? I can't see any way that would be interpreted positively.
Yeah,
The reason I
it sounds like that. I don't think it's going to be that much of a negative because it sounds like it's being foreshadowed. But I think complete and total victory, getting oil back down. If that ultimately gets sniffed out, then the market likes it. They're not going to like it on Monday, but they'll like it 6 months, 9 months down the road. But we're treating a cancer. You have to kill the cancer.
the reason I ask is because if you look at the oil curve, the front month is up, but the back months are not. So the oil traders are saying whatever is about to happen is temporary. Now, I think Trump's address last night, which really included absolutely no new news, was an attempt to convince the public that boots on the ground was going to be necessary. And I think that's what we're going to see this weekend. And if we do, I think then the back months of oil will start to follow the front months, and that will be very negative. But we'll see. I mean, this is a tricky situation. But the assumption is everything's going to be over in 2 to 3 weeks, and if we get boots on the ground, I'm not sure it's going to be that
Yeah.
easy.
I mean, it's interesting. Most people that I talk to who run actual businesses, are kind of thinking this is all, things suck right now, but, this is going to be over soon. I think that sort of the man on the street mentality is that this is so unpopular. There's no way this is going to drag on. And I think that's a real downside risk for the market and the economy for sure.
Yeah. I mean, people are still betting on EBITDA being strong, and EBITDA now means earnings before Iran, tariffs, and
Iran tariffs, and what was the last one?
Donald announcements. That's
EBITDA. All right.
It's great.
It's 11:44, gang. Let's wrap it.
Yeah, let's go. We've run long. Thanks everybody for being with us. No show tomorrow. It's Good Friday. Everyone have a wonderful Easter, a wonderful Passover, whatever you're celebrating, or just the beginning of spring, everyone enjoy the long weekend, and we'll be back next week. I'm sure there's going to be lots to talk about.
Thank you all. Thank you, Jen.
Thanks, Bakes. Thanks, Jen.
Bye.
Take care.